All right. Hello, everybody. Welcome back to another episode of the Market Open. Thank you, not Market Open, Market Close. Thank you, everybody, for being here. You know why I said Market Open? Because I'm actually a minute early. And that probably messed me up right here. But I am here a little early. We got a lot to talk about. Good old-fashioned little sell-off that we are experiencing in the global capital equity markets. We haven't had one of these days in a long time where everything kind of goes down. And towards the beginning of the day, it felt like everything was not going down. It felt like the Max 7, the software names were holding up, and some of them did hold up. But then you had the Googs that kind of messed up everything. The Googs, I think, and the headline on Google was part of the reason for why the hyperscalers, which were pretty green on the day. I think Apple is still green. Yes, Apple. I mean, look at Apple here. Still up 1%, but it did lose some of those all-time highs. It was trading at 334 to 332, but still up about 1.42% of the day, very close to that $5 trillion market cap. Meta, unfortunately, after that Google announcement, came down from 685 to 661. So what was the Google announcement that kind of took everything down? What was holding up the S&P 500 was Google, Amazon, Microsoft, and Meta. And given Google and Meta fell, Microsoft's actually still doing okay with Apple. Microsoft is, though, below 400. NVIDIA down 3%. The S&P now is down 1%. And, the kind of bright side to everything going on was that the S&P was holding up. The S&P not holding up means you start to get a lot more pain. Google came out and Bloomberg reported that their Gemini 3.5 Ultra launch is now being delayed. And as a result of that delay, that is why I think the market is upset about them. That really caused the cascading downfall that we've seen over the past 2 hours right there. So the reason it's being delayed, Bloomberg is reporting, is that the delay has been a source of frustration for Google engineers, AI researchers, and managers, many of whom are concerned that the company risks losing an edge in the market as rivals Anthropic and OpenAI's capabilities or models are producing even better capabilities than the latest version of Gemini here. So I don't know how real this story is, how important this story is. Maybe Google does have a model. They just don't want to put it out right now. And, the stock's at all-time highs. They're already diluted, so they don't really care the impact on the stock in the market. Maybe this is just a rumor from Bloomberg. But that headline in and of itself took down a $4.7 trillion company about 5%. And once those companies or those types of companies get hit, the Metas of the world, the Microsofts of the world also are getting hit. So that was, I think, kind of your core headline reason for why the hyperscalers started falling, which ended up taking the S&P 500 down about 1% right here. But in terms of the semis, it's a bloodbath. Nebius down 14%. Oracle down 7%. TSM, after those record earnings, down 3%. Corning down 10%. Micron, lows of the day as we're recording this right now, 846. That's down 6%. NVIDIA down 3%. T1 Energy, solar play associated with data centers, that is down 12.2% of the day. CRM's up a bit. Adobe's up. So some of your software names holding up. Palantir having a phenomenal day, actually 134.25. That's up on the day as well. ServiceNow was down 5% in the morning. It's now recovered 104.19. So that is also just slightly red, but basically flat on the day. AAOI is down 9%. Robinhood, which was pushing 117 yesterday, is now at 105. So pretty much all high beta when it comes to semis, neoclouds, memory, space, and then obviously some of your fintech names that have been getting hit right here. SoFi down 4%. They are all taking the beating today. And I mean, I don't know exactly when that necessarily changes, but in terms of what's happening today, that is obviously the momentum unwind that we are seeing right here. AMD falling below 500. I'm actually just seeing that right now. It touched 491, now 496. KLAC down 3, Navitas down 12. Lumentum, which was pushing 800 a couple days ago, that's down 7. Coherent is down 8.2%. So let's talk about why this is happening and if there's any real logic behind what is happening. First of all, I did buy the dip today. Nebius at 178. Obviously, it is still below 178. I thought, 200 to 178 in a day was enough of a dip, but the market had other plans. So put in the chat if you bought any dips at all. Buying the dip is a personal thing. I don't think anyone should be compelled to buy the dip on a day like this. I just personally think when you see this magnitude of a sell-off, and you might not have a massive position in some of these names, or you're building out a position, then I think it's okay to nibble at some of this stuff. And so Nebius was my nibble today at 178. Obviously, the stock continuing to still take a hit right here. TSM right here, also down 3% as NVIDIA is down 3%. My kind of core thesis on this entire sell-off that we've been seeing, not only today, but over the past month, today has just been a little bit more exaggerated from everything else, is that this is all sentiment driven. This is nothing that is fundamentally driven. Even if you take a look at the Google headline, right? Google is months behind its schedule on delivering Gemini 3.5 Pro, its most powerful flagship AI models, and engineers inside of Google are afraid that they're losing a competitive advantage to Anthropic and OpenAI. Does that mean they're going to spend less on CapEx or more on CapEx? Does that mean AI is more important or less important? Does that mean the ability to train and build new models is going to be more relevant or less relevant in the future? Like everything about this headline, yeah, it's bad Google, I guess, theoretically, because Google can't get a new model out there, which is why the stock's down 5%. But it screams bullish for all the semis, and it screams bullish for the broader thesis that Google is going to be spending on CapEx. I mean, the market is essentially pricing in, or they're acting like they're pricing in, now that the magnitude of the sell-off has been this aggressive. I know some of these names are still up a lot year to date. And so you could say, well, a lot of these names are still up, so they're taking a breather, which is totally fair. And I've been a proponent of that argument. But I think the disgustingness of how violent this sell-off is becoming is either this is a liquidity grab by the institutions that are really, shaking some weak hands out of these names because they know eventually that these names are going to be coming back because the CapEx is going to be going to them. But number two, and most importantly, the market's acting like the CapEx spend is over, like the entire cycle of the build out is over. And that's just not true. And if there's any objective reason for why that's true, I'm interested in hearing it. But from all of the headlines, all of the data that I've been seeing, it doesn't feel like that's the case, which is what prompted Mr. Gavin Baker here today, which is one of the best fund managers when it comes to AI. He had the exact same tweet, risk to reward seems attractive, on March 30th, which ended up being the bottom. That's not to say that today is the bottom. But the point is, when sentiment is the worst and when the pain feels like you just can't handle it anymore, which I know on March 30th, a lot of people felt that way, that tends to be when you buy. That tends to be when you at least take a nibble on some of these names because things have gotten so bad. He says lots of cheap stocks with durable competitive advantages that are going to crush numbers for the next 6 to 12 quarters, which I would agree with. CoreWeave's going to crush their numbers. Nebius is going to crush their numbers. ASML, TSM, NVIDIA, obviously, Corning, Micron, they're all going to crush their numbers. So whatever sentiment shift is happening right now, if it's rooted in the idea that the parabolic nature of these stocks needed to take a breather, then I'm fine with that. But if it's rooted in something fundamental, like the AI build out is over, then I think that's nonsense. I just don't think that's true. Again, I can handle these stocks going down for the reason that they went up too fast and they need to take a breather. They need to consolidate. I think that's very fair. That happens all the time. It happens with the best tech stocks ever. Throughout history, they've Uber, Amazon, they've all taken those downward moves. But if you're pricing in that the AI build out is over, then all these stocks are going down another 30, 40% from here. And I would imagine that the AI build out is not over, which means if they continue to crush earnings, their multiples theoretically should continue to expand, especially from these levels. So it's an interesting day. It's an ugly day. I also think the market is afraid of the Trump speech that we are having later today. Apparently that speech, which is going to be about Iran, is also going to be about election integrity, which I think the market, the general uneasiness around the concern around, what he could say is potentially causing a bit of a high beta sell-off right here.
It strikes me, listen, that prices will increase further before November.
Sure. Well, two separate questions. First, let me address what's happening in the Strait right now. We know that there is a blockade of ships directed by the president for ships entering and departing Iranian ports only. This has been fully implemented and is in full force.
Thanks to the conversation.
Did you guys see this? Was it stuck?
Was reimposed due to
Was it stuck right here?
Iran's inability.
Hold on, let me replay this. For some reason, the audio was playing, but the video wasn't. Oh, I see what was happening. Sorry. The wrong thing was playing. Okay, sorry. This is what he said here today.
About Iran, given the questions that folks on both sides of the aisle have about strategy and endgame, given that the United States has intensified strikes on Iran, typically in a time of conflict, when the president gives an address to the nation, you would expect him to address this conflict. Number one, will he talk about Iran? And why is that not the major topic of his speech? Does he believe that the SAVE Act and the 2020 election integrity are more important right now?
Well, no, it's not a matter of importance. It's just a matter of timing. The president will be making a very important announcement with respect to the integrity of our elections. However, it is also very possible at the top of the speech, he will mention the current situation with Iran and also the economy as well. As you
tonight and one on it.
So, if Trump ends up talking a ton about election integrity, I think that could be kind of scaring markets in terms of what is that going to mean for, going into the midterms. And then this is what Carolyn Levitt had to say about Trump's perspective on the the Iran war and the Strait of Hormuz?
We have seen with the increased strikes, a real decrease in commercial traffic through the Strait of Hormuz. What is the U.S. doing right now to facilitate flows through the Strait of Hormuz and preemptively address the risk that Houthis will actually choke off the Red Sea oil route and that prices will increase further before November?
Sure. Well, two separate questions. First, let me address what's happening in the Strait right now. We know that there is a blockade of ships directed by the president for ships entering and departing Iranian ports only. This has been fully implemented and is in full force. This blockade was reimposed due to Iran's inability to honor their agreement with the United States of America. More than 10,000 U.S. sailors, Marines, and airmen, along with 2 aircraft carriers and more than 20 warships and dozens of aircraft, are executing the blockade mission as we speak. And during the first 24 hours of the blockade, U.S. CENTCOM has redirected 2 compliant commercial vessels and disabled 1 non-compliant vessel. So, look, the Strait is open for ships that are not traveling to and from Iranian ports specifically, and the U.S. Navy is there to ensure that can take place.
So once again, the comments from the administration is that they control the Strait of Hormuz. Oil right there down a bit, 0.5% on the day. So at least it's nice to see some relief on oil. But obviously the high beta growth tech stocks have been taking the biggest hit. The U.S. CENTCOM said at 2 p.m., U.S. forces have begun conducting a new wave of strikes against Iran from the 6th consecutive night to further degrade Iranian military capabilities, as per U.S. CENT Command. So you've got escalation of the war. You've got oil that is still kind of stuck around that 79-80 range. And you've got a sentiment shift on semis without like a fundamental reason for the sentiment shift. I know some people have been saying, oh, what about that new model in China? Which, yeah, it's fair. Maybe a Chinese company worth $34 billion putting out a model that's as good as Anthropic's Opus 4.8 is begging the question around the valuation on Anthropic and OpenAI. But that's an Anthropic OpenAI problem. That's not a semiconductor build-out problem, because whether the models are open sourced or not, whatever valuation you put on those companies is irrelevant. The question is, are they going to be spending on memory, wafers, chips, CPUs, GPUs, et cetera? And if they are, the semi stack theoretically should be fine. It's just, I think the concern around OpenAI and Anthropic kind of bleeds into everything else. And I kind of think that's what we've been seeing over the past couple of weeks, this idea that the models might not be the biggest winners of this AI revolution, and that open source really is going to be how this ends up playing out. And unfairly, I think that's taken all the semis down, especially the neoclouds, which, as Jose said, Jose made a great point on the show today. The neoclouds are going to be the biggest beneficiary of this entire data center build-out, because their businesses theoretically are not even as cyclical as optics or memory, because it's just cloud compute that they're providing. And when you have a company like Nebius that is building on so many additional layers to the stack from a software perspective, it makes you think, the market is just throwing the baby out in the bathwater here with everything going down. Broadcom down 5% as well in the day, which might be just a little too intense. We do have Netflix after the bell. Netflix puts out their earnings relatively quickly. So 74.15, this one is staying flat. I put the pump and dump poll in the chat. 62% of you say dump. Let me know if you have a position in Netflix as well. Put in the chat if we have any Netflix shareholders. I do not have a position in this. I really don't know if it's going to pump or dump. The case for pump is that it's beaten up so badly. Like, I don't know if this market is in shambles to the point where this thing needs to go below 70 as a blue chip stock that a lot of institutions own. Like, do they mess up that badly on earnings for this to happen? Or, does the market kind of, and any piece of good news would pump it then, or does the market look at it and say, look, there's no growth here. There's nothing to be excited about. And there's a lot of better opportunities like the Max 7 that are trading at cheaper multiples than Netflix. The street's expecting 79 cents of EPS and 12.58 billion of revenue. So I really don't know on this one, but I have no position, and we are going to see how this ends up playing out. I see a few people here that have Netflix. Put in the chat if you bought the dip on anything. I see a bunch of people saying we bought DRAM. See a bunch of Nebiuses here. Rocket Lab and ASTS, again, those got hit pretty badly, although Rocket Lab's been doing a good job not losing 67. I mean, this is one of the charts I've been looking at today. I know it's down 11% here, but it pretty much bottomed, at least for the day, around 66, 67, and it's been kind of stuck here. So it feels like enough buyers have come in and said enough is enough. So hopefully, tomorrow we don't see a more exacerbated sell-off, but obviously that ASTS dilution news was bad for all of them. ASTS $55, that's down 70%. Where is SpaceX? Are we below 135? We are. Wow, 131. This is the lowest in 2 days. I'm just seeing that for SpaceX. So that one continuing to get hit right here. ISRG, we also have that on deck. We will have Chris on in about 20 minutes after we get through these earnings. And yeah, we'll get his take on everything going on here in the macro. Overall, my take on this sell-off is that it really does feel like liquidations, margin calls, algos, market makers sweeping for liquidity, people just feeling uneasy, taking profits. It just doesn't feel like it's rooted in something fundamental. And if it was, I would want to analyze the crap out of what's happening fundamentally that's causing the sell-off, but it doesn't feel like that. And so if it doesn't feel like that, it does feel like there are some more compelling opportunities that are out there. Thursday, July 16, 4 p.m., the stock market is now closed. All right, even with the ugliness of today's sell-off, S&P only down 0.5%. We actually got a nice little pump. We were down 1% into the close. S&P 500 right there, 750.76. Netflix is what we need to have our eyes on. Initial candle is green. We should get the numbers very quickly on Mr. Netflix. And let's see if sentiment is bad enough to have any piece of good news be the reason for why this stock can make a move. Again, Street wants 79 cents and 12.58 billion of revenue. Microsoft, did we actually get 400? We got the close on 400? Oh yeah, we did. We got a nice little $400 close on Microsoft. Not bad. Not bad. Netflix, 3% down. Is that real? Are those based on numbers? Now it's right back up. Wow, it just went 3%, then it went green. Now it's back to red. Okay, they missed on EPS. 82 cents versus 84 cents. That's probably why you had that initial red candle. Revenue. I think they missed on revenue. Let me try to confirm it. They definitely, wait, did they miss on? They missed on the guidance for EPS. Are they below 70? Not yet, 72.80. It's holding on. I have their guidance. Okay, so guidance looks like a miss on revenue and EPS. 12.86 billion versus 13, 82 cents versus 84 cents. But what about Q2 numbers? Q2 is what we're looking for here. 79 cents is what the street wanted for Q2. I have their Q3 guide numbers, which are a miss on the top and the bottom, but I do not see the actual Q2 numbers here. Now it's pumping right back up. So you had initial red candle. And now we are green. Okay, Netflix. All right, Q2 numbers. They beat on EPS by a penny, 80 cents versus 79 cents. They missed on revenue by 20 million, 12.56 versus 12.58 billion. So it's a beat and a miss. The miss is very slight. The beat is also very slight. EPS up 11% year over year. Revenue is up 13% year over year. The stock is basically flat. For Q3, the street wanted 33.5% operating margins. They're coming in at 33.2. That's a miss. EPS street wanted 84 cents. They're guiding for 82 cents. That's a miss. Revenue street wanted 13 billion. They're at 20.86 billion. That is a miss. So they missed on all Q3 metrics. But they beat on EPS for Q2, beat on revenue, or missed on revenue. Again, the miss is 20 million on Q2. Fiscal year revenue growth for 2026, the street thought they would do 51.7 billion. They are guiding to 51.4. That is also a miss. Operating margins, the street wanted 31.7 for 2026. They're coming in at 31.5. That is also a miss. Free cash flow, the street wanted 13.1 billion. They're coming at 12.5. That's a $600 million miss. And they still see their advertising revenue on track to reach about 3 billion in 2026. So they missed on pretty much all the fiscal year metrics and the Q3 metrics. EPS was a beat by a penny, and revenue was a very slight miss. And stocks relatively flat right here. Good things down
Right.
the road.
We do have Netflix earnings. They are out. Let's get to Mackenzie Sagalis, who's got the numbers. Mac.
Mel, Netflix shares moving lower, down around 3% on a mixed report. It is a slight beat on EPS at 80 cents versus the 79-cent estimate. Revenue is a miss, though, not by much. $12.56 billion versus the $12.59 billion expected. Tax payments resulting from the Warner Brothers Discovery breakup fee caused free cash flow to fall $1 billion short of street expectations in the quarter, but Netflix did reaffirm $12.5 billion for its free cash flow projection for the year. Guidance, though, falling short of estimates. Netflix guiding to Q3 revenue of $12.86 billion versus $13 billion, and Q3 EPS of 82 cents versus the expected 84 cents. Full year revenue guidance is narrowing, though the midpoint remains the same. The company reiterating that its ad business is a top priority, though it is holding steady on its full year revenue guide of $3 billion. And then so much of the focus going into this print was on engagement. Netflix saying that its first half had slightly faster growth than last year at 2%. But from here on out, they're only giving us a read on engagement once a year instead of twice. And just one mention of M&A. It says that it is still on the table alongside share buybacks. Those shares now moving higher after hours. Guys?
Mac.
And now it's back down 4%. Yeah, this quarter is, I mean, the numbers speak for themselves, right? There's nothing super impressive here, just looking objectively at the numbers. This was kind of the issue with last quarter. The only reason they beat was because of a $3 billion breakup fee for a failed negotiation, which is not really the most impressive reason for beating your metrics here. I wonder if they take her below 70. 70 has been really big psychological support. Touch 70.76, but that one is down. We'll go back to Netflix in a second, but Intuitive Surgical has a double beat. That stock is down 5. 12% EPS beat, 280 versus 250. EPS is up 28% year over year. Revenue, 2% beat, 2.89 billion versus 2.83 billion. That's a beat. Revenue is up 19% year over year. I don't know what ISRG said to get the street upset off of a double beat, but they definitely said something right here as the stock is taking a hit. The stock was already down 29% this year. So any good news theoretically should have been enough to maybe help it right here. In terms of their fiscal year outlook, they're guiding to about a 68% gross profit margin non-GAAP and 13% non-GAAP operating expense growth. Fiscal year revenue growth of around 15%. Nothing that's necessarily going against their numbers. ISRG, oh my, 7% down. Netflix, she's still holding 70. She is still holding that, but that's down 4. ISRG down 7 as we're getting hit. For those that are just joining, again, Netflix, they beat on EPS, they missed on revenue, they missed on every single metric, whether it's revenue, operating income, operating margin, or free cash flow growth for fiscal year and for Q3. I think that's part of the reason the stock is struggling here. Like, even if they had slightly beat, I mean, like operating margins, 31.7 is what the street wanted. They came in at 31.5. Like, there's just nothing in this report that's making the street say, all right, at least you gave us something here that we can work with outside of a 1 cent EPS beat for Q2, right? 70.50. All right, 40 cents. Are we going below 70? ISRG down 5% right here. It is also a pretty tough day to report, especially if your numbers aren't amazing. I think this was we looked at the stat in the morning. Goldman Sachs said the sell-off in July so far, we're 16 days into July, has been the worst since 2001. It was worse than 2020 and it was worse than 2008, worse than 27 years. So obviously the unwind of that momentum has been pretty aggressive. And so on a day like today where it continues, there she goes, under 70, 69.90 as Netflix falls 6% right here. It's taking the beating. It is taking the beating. I'm trying to load their website. Their website is not, okay, finally. It said service was unavailable. All right, so here's the actual website. Let's see if we can get some more details. But the numbers obviously are not really what the street likes. We're delivering increasing value to our members. Engagement is healthy, reflecting the quality, quantity, and variety of our offering. They did say they're only going to show engagement metrics once a year instead of twice a year, which similar to them scrapping the subscriber disclosures. They're less transparency is never good. It's not like they have to show this stuff, but if the numbers aren't the best, maybe they need to work out some stuff before they're easily going to show most of these numbers. The results of our recent price changes are consistent and with prior changes in expectations. We are leveraging AI to provide a more personalized, immersive, and interactive experience for members, enhance ad capabilities, and improve the qualities of our series. The entertainment industry remains dynamic and competitive. We aim to stay ahead by executing against our 3 areas of focus: delivering more entertainment value, leveraging technology, and improving monetization. Okay, again, revenue growth, 13.4%, operating income, 4.1 billion, operating margins, 33.4, which is up. No, it's down, actually. Q2, wow, that's the reason the stock might be going down. It's not even the guide. It's the year-over-year growth or year-over-year decline in op margins. Q2 last year, 34.1. Q2 this year, 33.4. I mean, if you're not going to have revenue growth, which has also declined. Last year, they grew 15%. This year, they're growing 13%, but you're going to increase your expenses. So you're going to decrease your margins, but you're not going to grow fast enough to justify why your margins are going down. I think the street's looking at it like, okay, why do we pay 25 times earnings for this stock, right? That might be the question here for why it's struggling, along with the free cash flow growth not living up to expectation. I mean, it's 600 million lower than expected, which is kind of crazy to me because they got a free $3 billion by Paramount. So why is free cash flow down 600 million? Unless the analysts got too excited about what the free cash flow should look like, or they're spending on some stuff that they don't need to spend on, or that is not, delivering an ROI to justify the yield on that free cash flow. So those are the numbers that you have. The rest of this is just outlining the new shows that they're putting out there. But those headline metrics, it's a little ugly, folks. It's a little ugly. Netflix right here, just touching that $70 range. S&P 500 down a little bit more after hours. SpaceX down a little bit more. ASTS actually getting a little bit of a move up. Microsoft got that $400 close. Intuitive Surgical completely falling off the cliff right here, even after a relatively solid report based on these numbers, as that is continuing to take a hit. Let's get a little bit more coverage on some of the chip names here, and then we'll pull up ISRG and go through their numbers.
Google, because it fell behind schedule on its next flagship AI model, Gemini 3.5 Pro, sending Alphabet shares over 4% lower, and you really saw that happen in the afternoon. The parent company reports earnings next week. You mentioned it, chips were among the biggest laggards on the S&P 500 and NASDAQ. SanDisk was one of the worst performers, specifically on the S&P, on fears that China in general for memory could flood the market with cheaper supply. There's also SK Hynix that fell in line with its move back in home in South Korea, where regulators are now stepping in to really calm the leverage-driven volatility we've seen as of late. TSMC, Taiwan Semi, beat its own guidance overnight, and yet the stock still fell, a signal there's really just no near-term catalyst left to re-rate many of these chip names. It was another momentum unwind hitting Intel, AMD, as investors really took profit and asked whether this chip cycle has peaked. The unwind, though, did benefit consumer staples, the best performing sector led by Molson Coors, Dollar General, General Mills, and healthcare. You guys talked about the defensive play. Well, it ended strong as well. United Healthcare hiked its earnings outlook as it really reined in costs. And then we did have an IPO today, C-Square. I just wanted to mention that the Brookfield-backed data center provider fell after its offering price below its market range, but down.
Which is kind of not good to see. A data center IPO falling below its price on the first day of the offering. I mean, it was just a horrible day to take this thing public, but now that it did go public today, you are seeing some of the pain there in these newer names. Before we get into Mark Mahaney, who I think is one of the better analysts to talk about Netflix, take a look at this stat as well. This is from Vanda Research. Retail is selling. Retail investors sold 125 million in SanDisk last week, the largest sale among any stock. This was followed by Apple at 120 million and Tesla at 105 million. They sold 65 million of Nvidia, 22 million of Meta, 40 million in American Airlines, and the 2-week retail sale volume in Tesla and Apple was negative 200 million. These were the top tickers: SanDisk, Apple, Tesla, Nvidia, American Airlines, Meta, Western Digital, Bloom Energy, AMD, Cisco, AMAT, Marvell, Palo Alto, Visa, and then you can see the rest there. You have Salesforce and Lumentum, Texas Instruments, and Schwab near the bottom. So definitely the sentiment unwind, if it's affecting institutions and hedge funds, I would imagine is also affecting retail. as they are locking in some gains. I mean, I would imagine a lot of people are up on SanDisk, given they bought that stock earlier in the year, and if they kind of don't want to stick around for the downside, then you are seeing some of those profits being taken. Here's Mark Mahaney on Netflix's quarter.
This. I mean, the context of the stock going into earnings is that it's lost almost a third of its value in the past 3 months. Does that say it all? I mean, was it just not as bad as feared?
Well, the fear level was super high. I think this was the sentiment on Netflix is as weak as at any point that I've seen in the last 4 years, I think, and maybe even further back than that. The market was widely expecting a miss and a lower, and the market got a miss and a lower. What was really surprising here actually was the engagement. The numbers that they gave suggested that there wasn't any slippage in engagement, and everybody had been assuming that, especially with the World Cup and then lack of kind of big content hits, that we'd have an engagement issue.
Netflix down 8% here. She's fallen now.
But there wasn't one, and the company kind of maintained its guidance for the full year. So I kind of think this is an at par quarter. Bar was low, and they may have tripped over it.
We're now seeing the stock down by 5 to 6%. I guess the company is now going to further ratchet back its viewership data to once a year. I mean, what's the message from all this, Mark, as people, as you suggest, are getting concerned about, I guess, both just engagement levels, but also whether, in fact, there's disruption risk if AI sort of slightly privileges YouTube, for example?
Well, anytime companies cut back on disclosure, it's never a good thing. A year and a half ago, I think it was, the Netflix announced 2 years ago, they announced that they were going to cut back on subscriber disclosures. That wasn't a good thing. And now they're cutting back a little bit on engagement disclosures. So that's never a good thing. And then I think the big risk that's kind of peering up in the markets looking at is the kind of not the attack, but the increasing competition from short form video content. And then from other kind of bigger services out there, whether it's Amazon and especially YouTube. That's what the market's focused on. I'm trying to step back a little bit here. I think this is a tough setup that the company had fundamentally for this print. What I particularly am interested in is what's going to happen next year when you're going to start getting hopefully a material rollout of short form video content. When I just assume this hit machine, and Netflix has always been a hit machine, there'll be another hit machine coming up. There'll be another hit coming up. And I'm sort of waiting for that when the market assumes that there aren't any more of those. And then finally, just as the World Cup was a big disengagement driver this year, I would expect the World Cup, Women's World Cup, to be a big engagement driver next year. Netflix is the exclusive streamer in the US. So I get the sell-off in the stock and the pressure that the stock's under. I think there's going to be an interesting setup for a dislocated stock that I think is still high quality to turn those fundamentals around into 27. But I don't see that happening in the next quarter or two.
You may be patient, but investors may not be patient, Mark, as we're seeing in the after-hour session. So do you think that this could force Netflix into doing something more dramatic to move the needle, whether it be acquisition or partnership, providing, partnering with a streaming service on its platform, bidding for live sports, which seems like a very costly endeavor to get into?
It could, but they've been bidding on live sports and increasing that catalog for quite some time. And I think even the MLB Home Run Derby that they just streamed, the World Baseball Classic in Japan, an incrementally larger number of NFL football games. Yeah, I'd expect them to lean more and more into live sports, live entertainment. Every quarter, I would expect more of that $20 billion in cash spend each quarter to shift towards that. If I wouldn't expect them to panic on something like this, but I may be wrong. I wouldn't expect them to panic on it. I think they'll stick with their script, stick with the playbook, and then work to get that next big mega hit out. And in addition, roll out more of this short form content and roll out more live sports entertainment. I think that's what they need to do. I think they can successfully do it. The stock's going to be under pressure near term and probably doesn't work for the next 3 to 6 months. But I think the setup is there for a pretty impressive 27.
Yeah, cracking just below 70. That was around basically the low from last month before this little rally. Mark, really appreciate you weighing in
Thanks,
right off the bat here.
All right. I mean, it's ugly here. It's been an ugly day. Netflix continuing the ugliness of the day as we see it right here. 7% touch 67 at one point. Yeah, I mean, again, looking at the numbers aren't good. They're just not interesting or exciting for shareholders here. I mean, even if you were interested in buying this stock, again, there's just other big tech names like Meta, Microsoft that are trading at the same multiple, if not cheaper. And so it just begs the question, do you want to trust the money right here in Netflix? But obviously, I think if today wasn't as bad, Netflix might not be down this much either. Like, I get the quarter wasn't good, but if all these stocks didn't sell off either, maybe that would help. So if we get a little bounce tomorrow, I would imagine Netflix could also get a bounce. Shark Ninja, that's down 0.5% after hours. Nike is down 0.5%. It was up 4% of the day. Your consumer discretionaries actually did okay today. Nike, Pepsi, etc. But these are all down. DJT, there was some interesting news there. So Truth Social, which is still public, you can buy a stock that is associated with Truth Social, DJT, Trump Media and Technology. They made $3.8 million last year on advertising revenue. So there's obviously not a lot of money they've been making in the advertising space. Apparently, they disclosed today that they're going to sell an API to hedge funds that allow those funds to scrape the data on Truth Social, which allows them to gauge social sentiment around what's happening in the market. That will essentially let them trade faster and use that data to be able to make better decisions when it comes to trading and managing capital. Now, this is not new. This is something that a lot of different platforms, Reddit, Twitter, et cetera, have done. They've sold the data on their platform to hedge funds and financial institutions, high frequency trading firms, in order to be able to gauge the sentiment on a stock. For example, if 10 million people are tweeting about Netflix, that is valuable data based on if they're bullish or bearish. But this is the president's social media platform. And the only posts that move the market on Truth Social, from my understanding, are not the millions of MAGA followers that tweet under Trump's posts, because I don't really think they're talking about NVIDIA and Amazon. It's Trump himself. Yes, it's a social network of one. So I think they're basically guaranteeing that the hedge funds will get hypersonic levels of speed when it comes to Trump saying something so they can make a decision, which begs the question is, I don't know, it makes you wonder, like, is Trump going to tweet stuff just to move the market for the sake of this new product that they're selling? Like, it's the fact that they're even doing this to me is just obvious conflict of interest. But I guess that's the best way they're going to be able to make money. Also, these hedge funds that are, what if these hedge funds are just buying the Truth Social API to be in good graces with the president because they want, to say, hey, we, if we want to get something done, we've supported DJT by paying for this API or whatever. So very weird. Doesn't really make sense to me. Similar to the meme coin nonsense. Like, it's just stuff you don't want to see. Netflix now really getting hit, down about 8.7%. But that seems to be what is happening here with DJT. Palantir down a little bit after hours. Meta up a little bit, and then Apple, after having an all-time high day, that one is going down. Where is Nebius after hours? 172, and then CoreWeave, that's down 0.08%. Twitter used to do this. I think X now has a closed walled garden for their API, so they don't do this anymore. But in the past, Chris Camillo literally sold his company. It was called Ticker Tag, if I'm not wrong. I don't know if he sold it to Twitter, but he sold it. No, I think he sold it to a financial institution. He literally built an API that scraped all the social media content around certain tickers on Twitter. This was like back in 2010. And some hedge fund bought it from him. That was one of his early exits as an entrepreneur. So I don't think Twitter does it anymore because Elon, likes keeping everything closed. But the business model makes sense. It's just the president is the one that, is operating the news flow around the platform. And so that's why it's more interesting than not. Robinhood obviously took an ugly hit today as high beta falls and market momentum starts to go down. Robinhood obviously goes down with that 116 to 105. So this stock was also down 8%, and then you got Rock Lab right here, down 11% on the day. So that is what we got, folks, for Netflix. Not a good quarter. We are not going to be listening to the call. I think Tanner will be streaming it if you care about listening to it. We're going to have Chris on the show in a little bit, and we'll get his thoughts on what's going on in the market. But Netflix is down 8% on missing pretty much every metric outside of a 1 cent beat on EPS. And then Intuitive Surgical, haven't gone through too many of their numbers. I don't know why that stock's down 7. It has to be down with guidance, but revenue and EPS was a pretty strong beat. And so unfortunately that one's getting hit. Is the Kospi closed tonight? Kospi, Is Kospi closed today? Why would it be closed? Kospi is closed today because the trading day. Is there a holiday in South Korea? Oh, it is closed Friday. I'm reading it right now. It's closed on Friday. I don't know why. There might be some holiday. Constitution Day in South Korea. Okay. That is why the South Korean markets are closed. All right, folks, let's bring on a contributor to this channel who has helped us analyze the state of the macro over the past 4 years and get his thoughts on what's going on in this market downturn. Ladies and gentlemen, Mr. Christopher Patel.
It's everyone's favorite villain. What's up? What's up?
You know what's so funny? The days where everything's green and you come on the channel and you're like, maybe we should buy some puts. Everyone hates you. The days when everything's red, you're like, get Chris Patel on the phone. We need to hear from him. So
I think the thing is, like, when you speak sometimes, and you look, you can try to rationalize the market as much as you want, but timing it is extremely, extremely difficult. Like, you just can't do it. So sometimes when I say something, I think people interpret it as, oh, I think he's just a perma bear. Like, he hates, like, dude, if I was a perma bear, I wouldn't be in the market. I'd probably just, buy like some like small yielders and just leave it alone. Right. But no, I mean, I'm bullish when you need to be bullish. And usually the best time to be bullish when everything is very, very bearish. And it's it's investing is counterintuitive, right? When everyone else is piling in, you should be piling out. And when everyone is, piling out, it's usually great opportunities to buy in. I mean, I think based on like some of the stuff that I've spoken about and I've actually gotten right, I think that kind of highlights like, okay, yeah, that strategy in the short term definitely feels super idiotic, but in the long term, it works. Like United Healthcare, a year ago when we were talking about it, it's probably not on anyone's favorites list, but it tended to work out well for everyone now, right? So I think we're sort of in the same thing with a lot of sectors right now that are a little bit unloved. And I think there's real opportunities that if you're willing to kind of take a little bit of step back from what the consensus trade is, that you can actually, buy some great companies on the cheap right now. So, yeah.
Okay, so let's get into a lot of the different issues that are going on right now, because I think there's a lot to get into. Let's start off with the semis in general. You are, contrary to popular belief, a bull when it comes to AI, a bull on CapEx. You believe that this cycle is important and that there's obviously been a massive change. The software companies, with tokens, they're going to be able to help grow their underlying businesses and become more efficient and effective. But you have been a lot more skeptical than most people on CapEx and just how long these companies will be able to spend this money. I think what has happened over the past 2 weeks is a sentiment shift in regards to the market questioning that same underlying thesis on how long will this CapEx keep flowing, which is why the traditionally cyclical sectors like memory and optics are starting to really feel the brunt of that pain. But it's also taking down everything with it, including the neoclouds and the large cap semis like NVIDIA, Broadcom, TSM. So broad question, but where do you think we are in the CapEx cycle? And do you think there's a fundamental reason for why the semis are down 20% in the past month?
I mean, if I had to try to pinpoint it, I think it really comes down to ROI, right? ROI is very important for anyone who's actually spending. Like the money right now is flowing out of the hyperscalers like Mag 7 and it's flowing into the semiconductor trade. I mean, that's pretty obvious, right? Like the more 2 years ago and I would say maybe 1.5 years ago, when these same hyperscalers were announcing just how much money they were going to put on CapEx, everyone was cheering on and the market was just loving it and basically just buying every bit of that. The challenge is, when you keep saying those numbers, but at the end of the day, you're looking at where that money is actually going. And yes, operating cash flows are growing. The challenge is people are not looking at the other parts of that, which is how much of it is actually going to go towards depreciation in the future. And one of the things that's a little bit uncomfortable is that, if you look at the depreciation timelines, they've kind of played a little bit of a game where they've kind of said from 3 years to like 4 and now 5 years. And some of them are saying 5.5 years. And while that's fine based on the H100 line, one of the challenges that I think people are starting to recognize now is, well, who are the main companies that are paying for this build out from the hyperscalers. And that's OpenAI and Anthropic. So there's a lot of concentration risk with just two counterparties. So I think a month ago, I think everyone sort of woke up to the idea that this token maxing craze wasn't going to last forever. I think a lot of companies, especially companies like Uber, they came out and said very bluntly, like, look, we can't afford the cost of AI to the level that's required in order to justify the current spending that's happening right now, at least not to the same degree in a compressed timeline. Maybe over the next like 5, 6, 7, 8, whatever years, everything will make sense. But there's no way that we can, at the current pace, be okay with what we're doing. So I think that pullback in spending. But I think what happened was, at the same time, you had all these other models come in, especially from China, saying, look, we can do things for much cheaper. And then you've got another competitor in Meta saying, hey, we got our own model, right? Then you've got yesterday with Thinking Labs, they came out and said, look, we've got this open weight model that's US based. It's not China anymore. So you don't have to be reliant on China. Satya Nadella comes out and says, listen, we don't think the world is going to be about these frontier proprietary models. Yes, 5, maybe 10% of the total AI usage is probably going to be at the frontier, but 90 to 95% is actually going to be, models that customers create for themselves so that they're not having to share all this information. So I think everyone kind of is reading into that and saying, wait a second, maybe OpenAI and Anthropic may or may not be able to live up to those RPO contracts. And if they're not able to live up those contracts, that means that the hyperscalers are going to have to reevaluate what their future CapEx is going to be. And if their future CapEx is not as strong as what we're expecting right now, that means that who's going to be hurt by that? It's going to be the semis. So what a lot of people said was, well, the growth is not going to slow down for the next 2 years. I think a lot of people are waking up and saying, look, the risk of any one of these hyperscalers pulling back on CapEx is starting to get bigger and bigger. And so that risk is kind of being translated into the market right now, where people are saying, look, we all know that at some point, this CapEx spend game that we have right now, the dance is, it's basically the game of musical chairs. And the people that are the most like skittish are trying to get out. They're saying, look, I made my money. I've already run up 700-800%. I don't need to be there for the last 10-20%. I can take most of my wins, get out and see wait to see what happens. I mean, I look at some of the super investors right now and I look at their exposure to the AI names, and they don't have a lot. Like, you look at Stanley Druckenmiller. Look at Stanley Druckenmiller's portfolio right now. It doesn't have that many AI names, and he's been unloading AI names. He's pretty much been dumping his money into healthcare. So when you have like veterans like that who've seen multiple bubbles, and they're sort of like, they're not going to, like, for some reason, well, I wouldn't say for some reason, but none of them are going to publicly come out and go like, oh yeah, I think the AI CapEx wave is over, and risk their reputations, because that's one of the challenges that you run into. Like, you look at Michael Burry. Michael Burry says a lot of this stuff, but he does have a lot of reputation risk, because if you call something too early, that's just as bad as calling something too late. So,
right.
So I think we're at a point right now where just the risks are elevated, and the market is just, skittish on that. Now here's the thing. This goes one of two ways. The rest of this year, the hyperscalers are going to have multiple opportunities where they're going to be able to guide for next year, right? And if at any one of those meetings they don't guide for what the market wants, that's disappointment. And what happens is, the bigger the share price of, let's say, Micron and NVIDIA and AMD, the more future CapEx is demanded by the market in order to justify that stock price.
That's a good point.
So the thing is, if we get to a point right now where, like Micron and NVIDIA and all these guys get way, way oversold, and then these hyperscalers come out and they come out with a number that's not overly aggressive, but let's say kind of like medium, the market will rally on that. But it's the exact opposite, where if these companies are trading at all-time highs and these guys come up with even a slight lesser number than what the analysts are expecting, the market will take that and interpret as, holy shit, the spending part is over, everyone get out. So I think that's just where we are in this. The probability now of AI CapEx reductions, or at least AI future AI capex growth reductions are now on the table. And the market is just, like I said, expressing that this is where we are in all of this. So
do you think the Iran situation has anything to do with the sell-off, or this is more CapEx sentiment driven?
no, I mean, I think there's definitely an element that's there, because the challenge is if you have this war and you have higher oil prices, these higher oil prices then bleed into the inflation picture. And if the inflation picture goes up, it's more likely that the Fed is not going to cut interest rates and might actually raise interest rates, which means now the AI build out is actually being financed by a lot of debt. Like about 2 years ago, that wasn't the case. They were funding a lot of it through operating cash. But when you have Oracle bonds that are trading at almost 8%, just think about that. Bonds at Oracle are almost at 8% right now. That means that any additional future capex that's not flowed through operating cash by a company like Oracle is going to have to go to the debt markets. And if the debt markets are demanding 8-9%, because now you're factoring in possibility of, maybe even insolvency, you got a problem. I mean, they're literally one notch above investment grade right now. So same thing is happening across the board with a lot of the hyperscalers, where they're going into the debt markets, and the higher cost debt is not a good thing. That's going to at least dampen the amount of money that you're willing to put in, because now you have a 8% ROI hurdle rate on top of already diminishing margins coming from the additional spend that you're going to do on hardware because everyone jacked up their prices. I think this is one of the stupid things. By being overly bullish on AI, I think the Mag 7 sort of like messed it up for themselves. Right? If you think about it, if you say, I have this potential to spend $1 trillion a year, do you really think Micron and SK Hynix and Samsung and Nvidia and all of these guys are like, yeah, I'm not going to try to get a piece of that? No, they're all going to raise their prices. They're all going to say, wait a second, if it's like one of the dumbest things to tell your counterparty that your demand is going to be so high. So what happens? They skyrocket your costs.
It's a fair point. I also think the day after Micron earnings, when Tim Cook came out and said, we got to raise prices because these memory guys are screwing us here, that was literally the top for Micron. And I think the market also got scared about A, memory inflation for consumer electronics, but B, they started asking themselves a simple question, which is, why should a historical supplier of a commodity with crappy margins have leverage over the biggest technology companies in the world? Is that sustainable? And B, why should it be worth 20% of NVIDIA's market cap? And people are calling for it to be, a $2 trillion. That would be half of NVIDIA. Like, do you think that sentiment in and of itself, the idea that these companies cannot become that big because that means, Micron was bigger than Meta for a week at one point, that just is too topsy-turvy in terms of how we should be thinking of sustainable business fundamentals that many of these companies don't have?
Well, the problem that you run into here is that unlike GPUs that are very focused on one specific thing, memory is in everything. So then what happens is if memory prices go up, now automatically all prices on a lot of other consumer electronics goes up. So the consumer feels it at the durable goods end. So what happens then? Inflation goes up. That warrants a response from the administration, who's clearly trying to get inflation down. Right? Like, if all of these costs are being bled into the consumer market, and people will say, well, DRAM prices are what's on a lot of the consumer products. Well, the challenge that you run into with that is that, if you look at HBM right now is just, you take a lot of DRAM, you stack it on top of each other, and you do it in a very technologically interesting way, and that's how you get HBM. The problem is, the more and more and more of these HBMs that you have, that means that it's crowding out all that DRAM. So the DRAM prices are going higher too. So that is the challenge that you kind of run into, where you're sort of inadvertently causing inflation as well. So, the government, right now, our economy is doing really good because we have this monstrous amount of capex that's being spent. And so that's hiring a lot of people, that's creating a lot of jobs. It's normally a good thing. The problem is, if all of that money gets concentrated in the Microns of the world and the memory guys, because they just fattened up their margins, that means that now all of that inflation is going to like I said, bleed into durable goods. And so that's why, like, if you look at it, and I don't think it's going to go anywhere, but you know that there were like consumers that launched a antitrust campaign against the memory maker, saying they colluded together to raise prices by basically artificially raising prices.
Yeah.
I mean, can you honestly blame them though? I mean, look, if I was Micron, and if I knew the demand was absolutely exploding right now, hell yeah, I'd probably raise prices too. Like, at the end of the day, I'm a businessman. I got to do what's right by my shareholders, right? So,
Okay, so let's say the capex projections for next year go up to the 800 billion that they're supposed to go up to, and all the Max 7 reaffirmed that they're spending on capex. Now that these stocks have corrected some 30 to 45% from their highs, do you think they're a bit more attractive going into earnings because their number is going to be good, their backlog is going to be good, and then the Max 7 just have to say they're spending on capex still?
see, this is the part that you got to love about the markets, because then the question becomes, well, if next year is going to be a high point, then what about the year after that? You know, like, everyone usually, when you have bearish sentiments kind of like come through the system, people will always discount any positive short-term news, and they'll just think, whatever, I don't care. Like, I'm looking at even further, right? So this is the same thing that's happening with a lot of like the SaaS names as well, where people are saying, oh my God, SaaS is going to be disrupted, and the numbers are saying the exact opposite, right? But people are saying, well, maybe next year is not when you're going to get disrupted, but you're going to get disrupted in 5 years, so I'm going to sell you off today, right? And so semis are kind of in the same like hole right now, where if sentiment goes negative, even if like the hyperscalers come up with a really strong number next year, then a lot of people will, as we get closer to the date, you know, like to next year, people are going to say, well, what about 2028? You know, and a lot of the projections that everyone is seeing in 2028 seems that they're probably going to be somewhat near a top, only because the amount of capex now is getting to the point where most of the hyperscalers, their free cash flow next year is going to be, you know, pretty challenged. They're not going to have a lot of leverage, and a lot of them have taken on debt too. So I don't think Oracle can continue the spend level that they're doing, or at least they can't like extend their spending beyond 2027 to the degree that they're spending right now without really having some issues. So I don't know. We'll see what happens. But I think that the market being down right now is not because the numbers are bad. Like, clearly the numbers are great for all of the semiconductor names, but it's that narrative that we could be closer to the top than we are to the bottom. And like I said, investors are just running with it, and they're getting out.
Yeah, it's a good point. The idea that all the Max 7 increased their capex, and you know, every part of that story is fine. A lot of these semiconductor names are down so much, they might get a little bit of a bump, but then you go to 2028 and you're like, are they going to spend even, you know, Meta's projected to do 220 in 2027, 220 billion. Are they really going to do 280 billion in 2028? And if they only do 230, or if they actually do 190, does that completely change the trajectory of growth? Even though there's going to be a lot of growth still for all the parts of the stack, but it's not going to be the type of growth that led to Micron going from 60 to 1,000 in the first place.
Yeah, I think there could be a point where the memory players actually become too hard to pass up, and you could actually make some money on a dead cat bounce. You know what I mean? Nvidia, if you look, like last year, dipped all the way to 165 on the same fears, and then, you know, and then numbers came out and everyone said, oh my God, wait a second, no, the growth is still good, and then shit rocketed up to 200 something, right? So I think what happens is when sentiment gets bad, you know, people tend to overdo the selling. And like I said, I can't say for certain that the same thing is going to happen for Micron and SK Hynix and Samsung and all of that stuff. But, you know, because they are a lot more commoditizable than NVIDIA is. Like, I think NVIDIA is still the king of training, you know, and that's not going anywhere. I think with Micron and all of these guys, because they've been historically cyclical, you may not get the same level of, I don't know what to call, like, reflexivity in this, you know? Yeah. So.
Okay. So this is
yeah. Sorry, go ahead.
this is an interesting question. Amit, if there is no demand, why is Micron and SK Hynix building new fabs? I think your response to this would be, it's not that there's not demand, it's that the premium you're willing to pay on the pricing power, particularly of the memory companies to service that demand, is coming into question.
Yeah. Yeah, that's always the challenge, right? Like, there's a story in Gujarati that we like, did you hear in when you were a kid? You know, the one day the king wakes up and says, I like onions. So all the farmers go out there and they start planting onions. And, you know, the market for onions next year when the season all comes up crashes and everyone goes hungry. Next year, the king says, I like eggplants. Everyone starts planting eggplants. And then the market, you know, goes up and everyone like, you know, harvests their eggplants and eventually everyone goes hungry. The third time, the king says, I like potatoes. And everyone's like, nah, screw that shit. We're not playing that game anymore. So it's a very similar thing where sometimes, you know, it's not that people are going to stop eating eggplants and onions. It's just no one wants to eat eggplants and onions every day, all day, right? Yeah. And so AI, I think the spending is going to be the same thing, where there is never going to be a time where we don't need memory chips anymore. But there can be times where there's too many people that planted too many eggplants, and all of those eggplants came to harvest at the same exact time. And that's what a memory cycle is, right? It's just you get this wave of additional demand that comes in, and there's just not enough customers willing to buy it. Now, the thing is, I don't know when that, you know, that harvest season is coming, but you can tell based on like a lot of the reports by, let's say, CXMT and YMTC doing their stuff in China. Some of the, I mean, me and you are working on a private deal right now where there are companies that are saying, look, we've got opportunities to cut down on the demand for memory, right? Like there are technologies out there that are trying to kind of like bypass some of this stuff. And you know, like the way that it always works is that necessity is the mother of innovation, right? So you kind of need sometimes difficulties. Like you kind of need some difficult times to make people wake up and say, you know what, there's other technologies out there that could help. And usually the bottleneck eventually breaks. Now the challenge is if you like I said, I don't think Micron and SK Hynix and Samsung are building these fabs with the idea that we want a glut. But they do know that there's going to be a lot more demand in the future. Would I like the sector to be a lot more linear in terms of its growth, where you literally see like a nice up and to the right? Absolutely. But sometimes that's just not how markets operate.
I was talking about this the other day. There are a lot of private companies that are working on memory optimization. A lot of them. Because someone has to solve this problem. And that doesn't mean that the Microns, the SanDisk, the Western Digitals aren't going to have insane earnings and insane demand, but it does mean that the hyperscalers are recognizing we cannot have 50% of our capex go to a commodity. There needs to be a solution to this that even saves us 5 to 10%. That would be worth, you know, billions of dollars. So
it's
I think
90% gross margins, dude. 90% gross margins. Like you had 90% gross margins from Micron. You had another 90% gross margins from NVIDIA. Then you got 90% gross margins from all the freaking power companies. What do you think is going to happen? Everyone's going to be like, screw that shit, you know?
It was funny. The day of earnings on Micron, I was on the airplane and I saw the earnings. I read it. And this is what you just said was the number one thought I had. If I had, it's easy to say this in hindsight, but if I had a heavy Micron position, like heavy, I feel like that would have been the reason I sold. Not because of momentum or excitement or numbers. I would have sold because I would have asked myself, is it possible for a stock I'm in that I have a heavy allocation in to basically have leverage over the biggest and most important companies in the world to the tune of 90% margins? That would have at least made me say, I need to trim. So, and some of the people that you and I know that are heavy in Micron, that, you know, they did trim because part of the reason was like, this can't exist forever. And the thing about like amazing tech companies that have grown earnings for years and years and years, which is why their stock prices have gone up, is they've been able to compound earnings. When you look at Micron's chart or all these other different companies, the earnings go up and down and up, and it's not in a steady line up and to the right. And I think now the market's questioning, do we just want to go buy the names that we know, Amazon, Microsoft, et cetera, that are going to have that compounded growth, or do we want to take a risk on the alpha on the picks and shovels? So I'll give that question to you. Are you buying any of the dip in semis, and how much lower do some of these prices need to go for you to be excited for it?
No, I'm not buying any dips right now on it. Just one interesting comment to make. When you think about this, the you got to look at the Taiwanese in terms of being forward thinkers. They're in a business like the foundry business is not an easy business, but one of the challenges that you run into is you can like right now, if you think there's one company that can grab the entire industry by the nuts and literally make a crap ton of profits in the short term, it's TSMC. TSMC can go to every single one of these guys and say, I'm charging you fucking 500% more on your shit. Like, you guys got to pay me. But they don't do that. Why? Because they understand if you increase prices so much, so quickly, everyone will look for alternatives. People will say, screw it, I'm going to do more foundries myself. So you got to really think, you got to realize that the Taiwanese probably have it right in that you don't want to raise prices too quick because, like I said, it just becomes unsustainable. So I think memory makers are a little bit, I don't know how to say this, but they need to
greedy.
be careful. They need to be careful in terms of greed. Yeah, like I get that you want to make money, but the thing is, like, if you turn the average person against you, you're gonna turn the entire market into a point where they're all gonna gang up and say, fuck that. Either you lower prices on your own, or we'll give you alternatives to lower your prices. So,
and Jonathan Ross said this a few weeks ago at a conference for NVIDIA. I mean, he was basically warning that the memory guys need to get their shit together, otherwise it could hurt a lot of the industry. Now, I don't think this whole sell-off is because of memory or whatever, but it's been one of the more egregious names that has taken a hit. How do you feel about the neoclouds right now, their backlog, and do you think they're attractive at these levels?
I think that there's going to be opportunities within the neoclouds that could reveal themselves in the next probably like 6 to 9, maybe a little longer. In that, if any of these neoclouds have contracts that are serviceable and they can actually do what, like get those contracts fulfilled, some of them are really going to be big bargains, right? The challenge that they're going to run into, of course, is the depreciation, right? So if you bought a lot of these chips and you're depreciating them over the next 5 years, like you're looking at the value of these things, they're going to drop, which means that you need to do additional CapEx to justify the next revenue cycle. So the question is, will the market be okay with paying those compute costs? And that's where your margin essentially is. Like let's say right now you buy something that's for $50,000, and each year the generated revenue on that thing is $11,000. That means every year you're making a 10% margin, because remember that 50,000 you're depreciating over the next 5 years. If you can extend it out to 6 years, now all of a sudden you got a free year. So a lot of the people that are investing in companies like CoreWeave, that's the logic, right? That's saying, look, we bought a lot of these H100s, we loaded them up, and they are actually lasting longer than what people are expecting. And that's where we're making this crazy margin from, right? So I think initially people thought, oh, this is only a 10% margin, but in actuality, it could be longer, especially if these H100s like hold up longer. And that's like the next cycle, like the B200s, if they actually extend longer and they get that premium pricing. The challenge, of course, is what are the renewal rates going to look like in the future? Right. And the thing is, no one can tell. Like there's multiple indexes that are being set up right now that track spot rental prices. Have you noticed that too?
Yep. Call sheet just came out with, I think.
Yeah, and I think just show everyone if you have it up. But it's a very interesting thing, because what happens is, when there's like a ton of demand, those H100 spot prices go up, right? But to rent per hour, and then when demand goes down, it comes down. So the thing is, that unit economics that you have changes, and that's when that can cause a lot of volatility in terms of like valuations on the neoclouds. So, if you just look like in April, from April 26th, look at the price of that H200 just skyrocket higher, and then it kind of came down in July, and now it's kind of like sitting around there. It's like I said, it's interesting.
Do you think this whole thing could collapse this year?
I don't know if collapse is the right word. Collapse is like, some people are thinking that this is going to be like another .com bubble, and everyone is basically.
Do you think it could have an epic blow up this year?
I don't think so. I think there's enough rational people to, like say like, hey, just calm down on your spending levels. Like AI is not going to slow down. Like there's no place where I think everyone is just going to say AI is complete bunk and everyone should just dump all their AI exposure and get out. But I do think that there will be periods where we can see drawdowns, like 30-40% drawdowns, and then we can see them recover. And I think if you really look at companies like Nvidia, they're more likely to be market performers even with their exceptional growth, where you'll see them like stock price go up maybe 10-20%. But it's not going to be like another, like, I don't know, 100% gain from here, like some of the analysts are calling for. Like some people are saying Nvidia should be 300, and I'm trying to look at it and I'm trying to say, well, what would be the market cap of this company? It'd be like, what, 6 trillion something, right? And then you've got 25 billion shares outstanding. I'm like, even if they ramped up their share buybacks with all of that free cash flow, it's not even going to dent their earnings, And so then the story becomes, well, what's the fair multiple that you want to pay on Nvidia? And is this durable? And how long is it durable? And at what point does that multiple compress because the growth is leveling off? Because if that growth levels off, then we could see Nvidia at a 10 PE, maybe even a 7 PE, believe it or not, if you're looking backwards. I know that sounds crazy, but if you think about it, like let's say all the hyperscalers, they cut back on CapEx, like growth. That means that Nvidia now is going to have to, number one, not get as much capital flowing to them anymore. So that's going to slow their growth down. But then all the hyperscalers are also diverting some of that money into their own infrastructure and their own TPUs and Trainium chips and Cerebras chips and everything else. So now the growth picture for Nvidia is no longer 90% of those AI spend is coming to Nvidia. Now it's like, oh, maybe 60% is coming. And then eventually it could be 30%. Now that doesn't mean that like the absolute dollar amount of AI capex is going down. It just means that that pie is shrinking for Nvidia. And like I said, if the market
do you think that's why Nvidia stock has been stuck all year, which is that TPUs, jalapenos, Cerebras, the market's thinking that share that they have of capex will go down?
I mean, that's how I would interpret it. I would think that the market is just looking at and saying, we're not pricing Nvidia for today, we're pricing it for tomorrow, and then tomorrow they'll price it for the next day, and then next day they'll price it for the next day after that. So it's just they're pricing it like that. So I would say you have to look at Nvidia in terms of how far out you want to go in terms of trying to price it. Are you trying to price Nvidia for tomorrow's, like next year's growth numbers, or do you want to price it based on the year after that? And can Nvidia sustain the current growth rate indefinitely? As far as I can tell, that's not a possibility. So
it's interesting, dude, because I feel like in the next couple of weeks, this could rip right back up and the sentiment could shift and the market could be like, yep, AI is it's just now that we've had, which was inevitable, like a 1 month downward move after 5 months of just straight up and to the right on the semis. I mean, for about at least 3 months straight, it was the semis every day, and software and Mac 7 were just getting obliterated. And we've seen a flip, which is why the S&P is barely down from its highs, right?
Yeah, I mean, one of the benefits that the SaaS names are going to get is that with all of these companies like basically like killing token prices and tokens prices going down, like that means that all the SaaS companies are going to say, hey, we can layer on generative AI features, charge a margin on top of it, and sell it to our customers that we have pre-existing relationships with. I mean, to me, that seems like a no-brainer. I mean, you look at companies like here's an example. You look at Salesforce, right? Salesforce is coming up with Agentforce. So everyone is like, yeah, I want to use AI to help my business processes, maybe not hire as many level 1 workers, right? I want to use AI. Well, the thing is, they can do it one of two ways. They can either try to build AI themselves, like the infrastructure behind it to try to optimize tasks, or they can actually look at the platforms that they already use and say, hey, listen, I can basically contract with a company that's going to help me, utilize AI to basically make myself more efficient. So as an example, like what do you call it? ServiceNow. Like ServiceNow is using AI internally right now and actually expanding it to clients and saying, look, if you're an L1 engineer and you get a ticket to do like small little things, well, a lot of that agentic AI can be plugged in and you can have an L1 agent where a person can talk to, let's say, a chatbot on Slack, and that bot can go in and do all that level 1 changes that you want. They can open the ticket, find the issue, solve the issue, close the ticket, send a report to the the parties that need to be informed. There's all sorts of governance issues that the thing can basically master.
You don't think Anthropic and OpenAI are going to try to come for that software stack? Because if their token costs plummet, they need to make a margin somewhere, and it would be in replacing a Salesforce, right?
Oh, dude, they're going to try. They're definitely going to try. I mean, the way that they're trying right now is they're going to a lot of these companies. That's why if you look at that thing with Anthropic and OpenAI, which is, listen, we'll come to your organization and we'll help you build like X, Y, and Z. I think it really depends on where the most ROI is for them. Like, I don't think a CRM system or a ITSM system is where these companies are going to be able to make too many headwinds. I think there's standardized platforms. There's enough people that are already trained on it. The cost of making ITSM and CRM software that's one of the biggest, I think, the biggest fallacies that's out there, in my opinion. People think that companies use software because it's cheap. And it's like, no, it's not. They don't use it because it's cheap. It's because they already know how to use it. It's already built into the organization. Like, the organization itself is so used to it. They've trained everyone on it, and all that data is sitting in that specific, that specific software product. So companies work on the premise of if it ain't broke, don't fix it. So it's going to be hard to pry away a lot of those software components from a lot of these companies. And especially if they can do it at a cheap price, then they'll be fine. So I think right now a lot of these OpenAI and Anthropic, they're kind of like getting a little bit desperate. Like, do you notice that they're getting desperate to sell tokens?
Yeah, I mean, Fable 5 expanding its access, desperation, and then more broad desperation from OpenAI around coming up with a house speaker as like their core. Like, it is kind of scary that if these guys don't figure it out, and I think we're incentivized to help them figure it out, but if they don't, because the Chinese are there and the token costs just get so low, like, what happens to those businesses?
Yeah, I mean, I think the revealing thing is going to be when that S1 comes out. And when the S1 comes out, you're going to see how much the actual cost of goods sold is for a lot of these companies. And if it's not something that Wall Street likes, it's not good, because I mean, like I said, these guys are the main drivers of that RPO for a lot of and it's not only them, by the way. I just think that the amount of concentration is pretty high among OpenAI and Anthropic. Yeah. But like I said, I'm bullish on software. I think a lot of companies right now, they're not replacing any of their systems. I think there is something to be said about future valuations never going back to the crazy high premiums that software got in 2021. Like, I'm definitely in that camp. I don't think that you can ever get to those kind of like levels of craziness again. But that doesn't mean that there isn't value in software, and especially with software that can build in AI features and do it at scale at a reasonable cost to the customer. I think they're going to be able to pick up a lot of forward demand, and the structure, which I think everyone is trying to be very critical of, and which is why SaaS has sold off for the last couple of years, which is that subscription-based model. I think it's sort of transitioning from pure subscription to now like subscription plus consumption. And yeah, is it less predictable? Probably, but it also means that there's a lot more TAM in it as well. So as an example, you're probably going to get layered on two parts of your business now. You're going to have your default access subscription fee, but then you're also going to have a consumption fee on top of it. And I know that sounds like stupid. Like, what do you mean? But these are the same businesses that back in the day, when you bought software, you bought that shit on a CD. I remember like back in the day when you bought like Adobe, right? You bought a CD and this, the software came on the CD, you loaded it up on your computer and basically, used Photoshop and Premiere and all that good stuff. And then Adobe kind of pivoted and says, look, we're going to go away from that. We're going to do every month, you're just going to pay a fee. Everyone was up in arms, dude. I'm talking about the entire industry was so pissed off. And eventually everyone kind of just got used to it and said, okay, well, if this is going to cost me X amount of dollars every month, whatever. And same thing, like Windows did the same thing. Like if you look at Office Suite, back in the day when you bought like Office, you bought Office, like you owned it forever. But, in the future, now everyone's like, you have to get a 365 subscription, and people got used to that. So I think over time, people will get used to the subscription, the consumption model. In the same way as everyone got used to that moving from CDs to, or actually loading it on the PC to using a SaaS model. And then now you're getting consumption. So, and I think the proof point of that is like Snowflake. Snowflake has actually proven that consumption models do work,
And what's the guy's name? The CEO of Snowflake? Srivas, I think he got a big compensation package tied to the stock-based comp. It's like $500 million compensation based on getting the stock up. So Sridhar Ramaswamy. So I mean, the company probably feels pretty confident that they're going to be net winners in the age of tokens. SpaceX and space. How are you thinking of that sector right now?
I think there needs to be some pullback because I think euphoria levels got a little too high and the valuations on SpaceX were just insane when the IPO came out. And I think Wall Street, man, this is one of those things that I feel like this is very corrupt, but you can't even say it's corrupt because they did everything legally, but it's just unethical.
Dude, 100% it felt unethical. 100%. I didn't even know it was legal to only unlock 4% of a company at this type of valuation, give 30% of it to retail, and then just slowly unlock the rest. Like, I didn't know that was possible. I guess that's legal, but 1000% it felt so unethical.
I think the part that got me also is a lot of the same companies running the IPO were also setting price targets that were just astronomical. I mean, any rational investor here, like on Twitter, like even like the most, like, I don't even know, basic retail influencer was like, I think this shit is overvalued. Like, it should not be this much. Right? I'm talking about like these mega bulls. Like you got to look for these guys that are just like, I'm going to buy this shit forever. And these guys are like, nah, this is overvalued. And then you have Morgan Stanley and so these guys saying, nah, this is an $800 stock. And I'm like,
I mean, dude,
what?
Stephanie Link on CNBC, I love her. I respect her so much. She was like at 157. It's a screaming buy. It should have been 175. And I'm like, Stephanie, come on, Stephanie. What is going on? And I feel like some people really got caught up into the potential of what SpaceX can do. But like, are we 3 years old? Like, that potential has to be matched to like the reality of the numbers, at least to an extent. Not saying it can't have a premium, but a $3 trillion premium, which it got to, it was kind of ridiculous, right?
Yeah, and I think someday SpaceX is going to be worth way more than $3 trillion. But the thing is, if you're trying to sell someone $3 trillion today, you're basically saying, hey, listen, buy something that probably is going to be $3 trillion in X amount of years, but buy it today. Right. And that's not how you generate alpha. You buy something worth less than what it's going to be worth in the future, not what it's going to be worth in 5 years. Like, if you do that, you're basically setting up the people that are buying for a underwhelming return, And so that's the part that gets me, that a lot of the same price targets, which I honestly think the price targets are just, I hate Wall Street's price target setting mechanism because they use a lot of weirds, like sometimes they work backwards. Like, I feel like SpaceX, they kind of work backwards. And that's what Steve was saying to me today. It's like, Chris, do you know what these guys are projecting revenue to be like for SpaceX X amount of years from now? I said, what? And I was trying to be very pie in the sky, as high as I could. And I still was under the amount that these guys are projecting, because they're essentially projecting way too much of a bullish case. And then you look at it and you're like, wait a second, I see what they're doing. They're setting the price target first and then working their way backwards.
Well, I have a friend who works in finance, and he was telling me, like, the Raymond James price target. His argument, and I think it's a reasonable case, is that to sell research, you need to have something to sell, right? If you just have the same 180 price target, like, who's going to buy if you have 800, you're going to get a lot of people that want to buy and each page in the institutional research is like $1,000, right? So if you have something egregious to sell, it could be literally just they're trying to make money, but they're sacrificing a lot of credibility for that. Now, to your point, maybe they believe that, but 800 in a year, $11.5 trillion market. The only way I can reason believe that an institution like Raymond James would do that is to make more money, not for credibility, because the credibility is ruined after that.
Two things. One, Goldman Sachs is up 29% year to date. Yeah, because you got these sweet freaking fees that they got paid for doing this IPO. You know, that's number one. You got all of the debt issuances that's happening all over the AI space. So they're making money on that. I mean, look, Goldman makes their money by doing some stuff that, you know.
Dude, and here's the worst thing. Goldman is hedging their entire position. So they're supporting the IPO, like they're providing liquidity, but they're delta neutral. So every dollar SpaceX goes up or down doesn't affect them. They're not a fund manager. They're hedged. So like they make the money off the fees and they have zero exposure to the downside as a market maker or as a liquidity provider, because, you know, they're covering their position. Whereas someone like Cathie Wood, who buys it on the first day, is down a couple $100 million in 2 weeks.
Here's a funny thing. Do you think Cathie Wood has any influence left over this market?
No, not at all. Not at all. I think you're allowed to make some mistakes and have some screw ups and stuff like that. Everyone has it. Buffett has it, but you can't say Zoom's going to 1,500. You can't say Tesla's going to be 5,000. You can't have some of these targets and then be respect. Like, that's what I'm saying. Raymond James, next time they put out a price target, if I see Raymond James in front of it, I'm going to really question who the hell is making this price target at the firm, because that 800 thing just completely, you've lost me there if you're trying to sell me that type of research.
I don't know if this is 100% true, because I heard it, but I have to research it more. But what Elon tends to do, and it's probably right, is he plays the Thomas Edison card. Do you know what the Thomas Edison card is? Like how Thomas Edison raised money?
No.
So one of the things that Thomas Edison did was go out there and says, I have this idea for this one thing. It's called a light bulb. And this light bulb is going to transform like how we operate, and everything is going to basically be illuminated, and we're not going to have to use kerosene lamps and blah, blah, blah. And everyone got interested and started pouring money into Thomas Edison's idea. Motherfucker had no idea. He just hired a whole bunch of people and said, hey, listen, these investors, I got to solve a problem. They just gave me all this money. But the thing is, like, I needed this money before I solved this problem. And so now he just hired the best people, and eventually he just solved the thing. So Elon's probably the same thing. I mean, he's just saying, look, I need money to build these AI data centers, you know, super, like, what are they called, in space? I don't have them yet, but I'm going to do that. Give me all your money today, and, you know, eventually I'll make it work. So a lot of people said, okay, Elon, here you go. Here's money. And Elon's got the backing now to, you know, create the next light bulb.
Yeah, and again, Elon is doing his job by keeping the stock elevated the best he can, and you know, showing that his ideas can have a lot of potential in the future. The problem I had with the SpaceX IPO is all of his buddies went on TV and tried to act like it was a rational valuation when, you know, we know it's not. Like, if they were all professionally managing money, they would not buy it at $2 trillion, because they know the downside is aggressive. So
yeah, I think I'm not saying Elon is a bad guy. I think he's like like one of the most unique people on the planet, like one of the best innovators on the planet. But, you know, he also understands the capital markets, and he understands that he wants everyone to win. But unfortunately, that's just not how life works. There's always going to be some people that win way more than others, and he has to accept that. And he has to say, okay, well, look, I have this idea that I think can be a really, really, whoa, what the hell is that? Is that Netflix?
Dude.
Bro, I remember when Netflix was your arch enemy, and I'm sure you're dancing all the way to the bank now. You're saying,
No, because
I don't understand this shit.
I had a thesis 3 years ago that YouTube would win. I was wrong. Netflix was like $15, ended up going to $120. But that thesis, I think, was a sound thesis, which is that they don't have the ability to produce content like a lot of the other media platforms. I think I was just 3 years early. Like, we needed to get a bit more maturation, but the problem is still there. And that problem isn't going away as easily. Would you think about buying Netflix at all here? Or
I haven't really looked into it, but I do think that they're running into the same problem that pretty much everyone is running into with these streaming services. Netflix by far has the most reach, has the most amount of users, on there. But where else are they going to get more growth? Like, the only thing they have is just raising prices at this point, right? Like, there's just not a lot of incremental space left. And the question then becomes, well, if you can't raise prices, because then you'll have like, look, I'll be honest, dude, I use Netflix. Like, I don't even know why I pay for Netflix, because I maybe watch like one show, maybe two, like every other week. 90% of my consumption is on YouTube, if not more. So why would I want to, like, Google Premium is way more value to me than Netflix is, right? So, I mean, I keep Netflix because I get a discount from T-Mobile and I'm grandfathered into some stuff. So I'm like, all right, whatever. And then there are still some shows, but if Netflix says to me tomorrow, like, hey, your bill is going up by like $10, I'd be like, nah, bro, I'm good.
Done.
I'm good. Yeah.
And now that they're getting into live TV, I'm like, they've run out of ideas. Like,
we're reverting back to cable TV again. They're just paying all the streaming services by individual bills now. It's funny with the cable companies are doing. They're going to the streaming services and saying, hey, listen, if we get you a certain, like, client, why don't you just give it to us and we'll bundle them together? And I'm like, that's the goddamn cable TV model from like 20 years ago. You just get a whole bunch of channels, you bundle them together, and now you sell that bundle to the customer. I'm like, this shit is right back to I'm paying for Lifetime when I haven't watched it.
And guess what? You're selling ads in between it, which is what Netflix is doing now.
Yeah, it's like, welcome back to cable TV, baby.
Yeah, Meta and Microsoft are still trading at the same PE as Netflix, and they're just better businesses. So, but like, to your point, this AI shit is supposed to help companies, and with Netflix, we're not seeing any, productivity, efficiency, and if they actually get into prompting your own generative AI content, they're gonna have to start getting into the CapEx game, because they're gonna have to get a lot of compute from one of the big three to get all that content out there if it's prompted. So yeah, it's hard to kind of see the easy bull case. However, it's a blue chip stock. I think the institutions will support it at this level.
There is one thing I do think that if SpaceX gets right, and from what I can see, they are getting right, they could be the biggest telecommunications company on the planet. And that is something that could be a TAM that's just crazy, dude. If you go to any airline right now, all of them are using SpaceX. You go to any cruise line, they're all using SpaceX. If you go to like most what do they call, rural areas right now, where like a mountain cabin or whatever, and they have the internet, 90% of chance it's probably going to be SpaceX. So they're capturing like a lot of market share in those respective segments. But one of the things that could happen in the future, and I think they're trying out the technology right now, which is they can provide backhaul MVNO services through cell phones. And I know that sounds like, what do you mean by that? It's like, okay, imagine right now you are traveling between Las Vegas and LA. How many times does your phone drop off? Like, you get these dead zones, right? The reason why is because it's uneconomical to build a cell tower every like 5 miles. Right? Like, you have to, the amount of money that you have to put. So sometimes people just say, look, I'm not putting a goddamn tower around this area. It just doesn't make sense to do it. And if I do put it there, like 5G only goes up a certain amount of like distance. but the satellites can converge a whole swath of an area. So I think SpaceX eventually is going to get
ASTS supposed to be doing that?
Yeah, they're doing it too, but I'm saying SpaceX is also doing it, but they're way more funded. Like they have a lot of funding that's out there. The key here is SpaceX could one day launch its own cell phone service, right? And basically provide a very similar thing where they, if you're connected to a tower, SpaceX will pay the MVNO partner, and then, basically they'll charge the people to be on the SpaceX mobile broadband network, whatever. Or it could be the reverse of that, where it's let's say you're on T-Mobile, you'll be able to connect via satellite, using SpaceX, and SpaceX will collect margin that way. So it's kind of like, I wonder which way they're going to go with it to monetize. But I do think at some point you're going to get to a point where they are going to partner with almost every like mobile plan on the planet, or they're going to try to disrupt every mobile plan on the planet and basically become like a default hub for connectivity. And they're going to be able to extract margin from that. And if you think about the scale, that's 8 billion people. If I was Elon, and I'm pretty sure he's going to do this, he's going to focus on saying, look, we have 10 million SpaceX subscribers. And then you're going to see, now we have 25 million subscribers. And then we have 100 million subscribers. And then there's going to be like, we have 500 million subscribers. And that linear progression is something that's going to be insane to see. And if that comes up and those revenue numbers start showing up, I mean, dude, this thing really could become a $10 trillion giant.
What do you think about the ASTS $1 billion raise? Do you think that's what they need to be doing? And the broader space sector,
they're doing
$1 billion.
They're doing a billion. I just think that like a lot of the space stocks, they got a big boost from valuation of SpaceX. So everyone said, well, if SpaceX is worth X, these guys should be worth Y, and basically everyone just kind of wrote it up. But you also have to remember that you have to get some future cash flows out of this. So ASTS eventually is going to be generating cash flows from their partnerships with the other MVNOs, but it's not there yet. So people are saying once you actually start to see that revenue, I think ASTS could re-rate depending on where this ends up. And remember, they also have to compete against SpaceX while riding on SpaceX rockets. I mean, like if you think about it, SpaceX charges a certain amount of money to put like your competitors like satellites in the air, and then they have their own cost, and their own cost is probably, I think, like the last time I checked, is like 10% of what they're charging everyone else. I mean, that's just how things are. I mean, they got the technology. So what are you going to do? And so they're like, if there's a civilian way, like they're the only private company right now that can do heavy payloads in space, as far as I can tell. Like there are other companies, but they don't have nearly the amount of reliable platform that like Falcon Heavy does right now. And then the minute Starship becomes a lot more commercially viable, that's going to lower the cost even more. And then you've, of course, got like V3 satellites that are supposed to like go up exponentially in terms of the amount of people it can serve. So that's another growth vector. So if you believe in the growth of this, then there will be a price where I think SpaceX is a buy. Even if, like, let's say the numbers today don't necessarily make sense, you kind of have to look out a little bit into the future. And so that's why on Twitter I asked, like, what would be a price that you would buy SpaceX? So I'll ask you, what do you think is a good price for SpaceX? What would you buy it at?
I feel like under 100. Yeah. I mean, I feel like that's, I don't know if it's 75 or 80 or something. And maybe if it gets to 105, you pull the trigger, but you got to get under 100 at some point. I don't like that 96% of shares have yet to be unlocked. That to me feels like a disaster waiting to happen unless there's another big Anthropic deal that they can use to pump the stock.
Yeah, I think we'll probably see a period of consolidation somewhere, and it just depends on like where IPOs have consolidated in the past, and there's of course some macro valuation that you have to take into consideration as well. So if the entire market is dumping, SpaceX will probably get dumped too. If there's any sort of like recession or something like that, and I think that's where you get the opportunity to really buy in and then just hold the damn thing, and hopefully Elon does what Elon does, and you'll walk away, with a multi-bagger on your hands. And I think actually SpaceX could be a durable business that can compound rapidly. You know?
Are Rocket Lab and ASTS interesting at these levels, or you need lower from here?
For me, I think Rocket Lab you need to be lower, only because the amount of capex that they're going to have to do in order to support a space constellation is very high, and they also have to compete against SpaceX, which is way better funded. Now that doesn't mean that like Rocket Lab is going to go back to like $4 or anything like that, but it does mean that there's going to have to be a material move down to account for the risk of all of their future capex that's not going to be diluted. So right now, if you look at like Rocket Lab, they're not generating cash. They're just did an ATM at 150, I think 150 something. Like you got to give it to their 130. You got to give it to their CFO. The guy is smart. He's like, listen, if investors are willing to pay $130, I am all for raising that cash, because I am a business that right now is burning cash. It's way better to issue shares at 130 than it is to issue them at 10 and dilute the shit out of your shareholders. And it's even better than trying to take on a whole bunch of debt where you're basically, you know, in the future, you've got these obligations that may sink your entire business. So I think in terms of like capital, they're pretty good. It definitely extends their runway significantly. So I do think that at some point Rocket Lab will be oversold and it's actually be worth buying. But I would say until they start to get some material revenue and, you know, like their cash flow burn starts to calm down, I'm not sure like how to value the company, you know, like it's any one of these space companies is going to be very hard to value because you don't know what the business model is right now, because this is a completely new industry.
No.
You know, I mean, it's one thing if you have like a semiconductor industry or a garbage like collection company, like you have other competitors out there right now and they've got certain valuations and, you know, businesses, they all have three things in common. They could get like similar margins depending on the quality of the business. They've got capital structures that, you know, that you can kind of analyze. And then of course you have like the market sentiment around that specific industry and then layer that on and, you know, create a price target. But this is an industry that's still in its infancy technically. So how do you value that?
Are you worried at all about what Trump is going to say tonight?
Man, I'm always worried about what Trump is going to say. This guy every day is like a new thing, man. It's so weird because one day he'll be like, we just made a deal with Iran. And then it's like, guess what? I just bombed them. You know, it's like, I thought we just did a deal. Like I went in the morning and I just typed in Iran, right? And it's like, Iran, like Trump makes a deal with Iran. And I'm looking at it and it says 24 hours. And then the next headline right under that is what do you call it? Targets hate in the Strait of Hormuz. I'm like, didn't they just like negotiate something? Like mediators are talking and bombs are landing. And it's like, I don't know what's going on.
Do you think he doesn't care about the midterms anymore? He doesn't care about he doesn't care about the economy anymore. Do you think he kind of cares about staking the entire legacy of him as a president on this Iran situation right now?
I don't know, dude. I mean, 2 months ago, it was no one can pose a toll in the Strait of Hormuz. And then he comes out and says, guess what? America's going to be the guardian of the strait. We're going to charge 20% now. And even the Iranians are like, that's a bit too high, man. You know? I mean, the Iranians are coming out and saying, hey, man, that's a little too high. You know?
Yeah, I mean, hey, if you want us to take all your business, we can, but 20%. Now, and then people are like, oh, it's the art of the deal. It's like, hold on. You're telling me in 24 hours, Trump went to Kuwait, Bahrain, and all the Middle Eastern allies and said, I'm going to give you a 20% cargo tariff, and I'll only take it away if you invest more in the country. And within less than 24 hours, all of those leaders were like, yeah, we're going to invest a ton in the United States.
No, he just said he was going to put this shit together. And all of these guys called him and said, Mr. President, what do we got to do to not pay this 20%? And Trump said, well, you could invest more in America. And they're like, I guess we'll have to pay America a little bit of money. I think it's fine in the short term. He's like the gangster.
I don't even think, who knows if they're even going to do it? Who knows if he's just saying it to say it so it sounds like a win, right?
That's 100% true. It's politics. It's politics, man. You know, I mean, look, if there's one thing the president is known for, it's this like making everyone feel like he got something out of somebody. And I think that's what it really is.
Yes.
Like the GCC already heavily invests in America. Yeah, the problem is the GCC countries, they invest in us because they like investing in us.
Yeah.
You don't want to put a gun to their heads and be like, invest in America or we'll let Iran kill you. Like, that's not how you run policy, man. And a lot of these countries are like, yo, we need to calm. Like, once this guy is out of power, we need to figure out ways that we are less dependent on the United States. Because every time we get in bed with these guys, they literally just, you know, they go for the wrong hole, bro. You know, and these guys are getting tired. Make love to me. Don't, you know, shaft me.
I think the speech tonight is also going to be interesting because Carolyn Levitt said it's going to be about the election integrity of the country. And I think he's going to bring up the 2020 election again. And if he does, I wonder what the market's going to say. I wonder if the market's going to be like, oh, this is super unstable. Like now you've got people up in arms about election integrity. And what does that mean for the midterms? And is that a way of him front running that if the Republicans lose in the midterms, he can say it was rigged? Like these are a lot of bigger questions now that I think we potentially are transitioning to.
Yeah, I mean, I look at this and Trump is really, really trying to push for the SAVE Act, you know, and basically like the Election Integrity Act. He did a symbolic protest by not signing the Fair Housing Act, not Fair Housing Act. It was like a legislation on housing, which was supposed to get Wall Street to kind of like not be such heavy investors. And it was passed. Like this is one rare piece of legislation that was actually supported by both sides. And he refused to sign it because he said, no, I want the SAVE Act to be, you know, to basically join this. So I do think he's going to, here's my question to you. Do you think that the midterms are going to flip for him?
I don't know, dude. Like, I don't know if Americans are happy with him or not over the past 2 years. I really don't know. Like, the stock market's up. So investor 401ks are up. Jobs are up, right? So all those core things are good. But the Iran situation is bad, but it hasn't really hurt the stock market. We're still at all-time highs, basically. And GDP growth has been strong with jobs. So theoretically, the lineup for him or the recipe for him to win is in place. But I don't know if the Iran situation is going to be enough to, because the only thing that Iran could do to really hurt his chances is raise oil prices. But it's tame, right? We're not at 120 for a barrel of oil anymore. So unless oil spikes up aggressively, I think theoretically they should be okay.
This is where we are in the world. Our politics are being driven by the market rather than the market being driven by politics.
100%.
You know, I feel like, I mean, as an investor, you got to love the consistency on this. That means that every time there is a major dip, it's buyable because you know that the president is going to create a system where the markets run up again. Whether that be through pure jawboning the hell out of the Federal Reserve into being a little bit more, you know, tame when they're calling for the rate hikes, or whether that be getting companies to spend more money on domestic manufacturing or blah, blah, blah. Like, this is the one good thing about Trump, I would say. And I'm not saying it's a good thing, but other presidents, they're not nearly as hands-on with trying to dictate how the markets go. So the thing is, there's a lot more uncertainty around like buying the dip versus Trump, which means like literally every dip is going to get bought. Or at least he's going to do everything in his power to get that dip bought. That was the exact, I mean, remember at your meetup in LA, when I was talking to all these people, I said, look, this president has shown that his barometer for success is the stock market. There is no way that he continues this war and crashes the market and risks losing the midterms. I said he will pivot fast because the market's already down. So I think we're kind of going to be the same thing.
If he still cares about the midterms. Like, I've kind of got this theory that as a president, you have one major piece of legislation you can get out per 4 years. He's already done it with the big, beautiful bill. We're about to start the campaign cycle for 2028 as we get into 2027. I mean, I don't think the Iran situation is going to be resolved overnight, right? So what if he doesn't care about the midterms? What if, because in the next 2 years, what can he, even if the Republicans get a supermajority, what is he really going to be able to do in a meaningful way? Like, what legislation can he actually, if he can't, then maybe he's just like, all right, this Iran thing, I'll be known as the president that stopped Iran from getting a nuclear weapon forever. And that's my legacy.
I still am under the camp that the worst thing that can happen is like the Venezuela situation where we just picked that dude up and that shit was such a successful operation that Trump said, oh boy, shit, I could do this shit everywhere else. I could do this shit to Cuba. I could do this shit to Iran. And so that kind of gassed him up to take a bigger risk, you know? So this is where human emotion is, right? Like you get a string of successes. You think that you can do no wrong. And the next thing you go higher. I don't know. I don't know how he's thinking, but from what I'm reading, and I've read this in multiple press reports, that a lot of what he does is not pre-planned.
No,
like he shoots from the hip a lot, to the point where even his advisors are dumbfounded and they wake up in the morning like, what the hell just happened? Like, did he speak to you about it? They're all looking at each other in the situation room together and be like, did this shit just happen? You know? And they find out afterward, and they're just a bunch of guys like following him around with the mop, just cleaning shit up. You know?
Sounds like the way I trade.
Yeah. You know who the head janitor in the Trump administration is?
Bissent.
No, I think it's a combination of Rubio or Vance. Like both of them are just the cleanup guys. Like Trump will say something crazy, and then these guys have to kind of like come back behind him and be like, no, he didn't mean it like that, guys. Just
bro, the worst part is they'll gaslight you into thinking you saying, hey, this is kind of crazy. And they'll be like, how absurd could you be for saying this is crazy? It's like, bro, it's objectively fucking crazy what he just said.
Yeah.
You know?
I think the funniest thing is all the rizzing that these guys do, like during the meetings at the White House where they live stream that shit. And they're like, Mr. President, we would not be anywhere if it wasn't for you. You know, you're the best president ever. Like, the traffic lights are working because of you, Mr. President. Like, and I'm just sitting there like, these guys, these are all billionaires and millionaires, and clearly they know that it's not because of him, but everyone is just like patting him up, you know, just rizzing him up.
The good thing is the stock market's up and jobs are up, because if those two things weren't happening and Trump was making billions off crypto and all these side deals that he has with all these different companies, I think that's when people get really upset. But jobs are good, stocks are up, and that's enough for people to be like, all right, if Trump's making money, then who cares, as long as I'm making money with it.
Yeah, not rizzing. I'm sorry, I'm not of this generation. I got the word wrong. It's glazing. Glazing is the right word. Yes, glazing. Oh God. Yeah, I mean, we're not going to have a lot of stuff to talk about once this administration's over. I mean, this administration is content gold, baby.
It is.
You know, you wake up in the morning, look, have you ever had, since president, when Trump took over, any shortage of information to talk about in the market open or the close?
Not at all. Not at all.
In terms of content?
I mean,
in terms of content, this guy's amazing, dude.
Dude, and he gives you a generational dip every single year. Like every year, he gives you at least 130% drop, and you just buy the shit out of it and just wait.
And it always seems to be like around March. I don't know what the fascination with this March timeline. COVID was during March. Then you got freaking what do you call it? The tariff bullshit, March and April. Yeah. Then you got this Iran situation around end of February, March. It's like, like I wonder what he's gonna do next March. Are we invading Cuba?
There was a Wall Street Journal article about that the U.S. is thinking of airstrikes on Cuba. That came out last night. I don't know.
Did you hear about Pete Hegseth now? Like everyone is like over 30. They're going to be doing like testosterone testing and doing testosterone.
The High T Department of War. Yes.
Look, I was in the military. I can tell you, not every person needs a shit ton of testosterone to function. There are plenty of people that work on the base that just do like HR work. You're not gonna. Those are not the people that you want to have, like, you know, like giant warfighter. I'm not saying they should be unfit, unhealthy, like fat asses, but one of the things that people don't realize is with testosterone, especially testosterone placement, is that if you have a cancer in your body and you take testosterone and it's a hormone sensitive like tumor, it can actually like cause you to like have we call it like grow that cancer at a very rapid pace. So there are inherent risks that come with this. This is not just a simple like, you know, play StarCraft, like you just give your Marines a stim pack. You ever played StarCraft? I never asked.
I've not. No.
I guess you're from a different generation, but like in StarCraft, you had like the Marines, which is like your core like fighting force, and one of the things that you do to basically like just juice everyone up is you give them a stim pack. So I think that's what we're doing right now. We're giving our soldiers stim packs.
People thought it was AI when I showed the video yesterday of him saying.
Did you really?
Yeah, they're like, there's no way he's forcing people to have certain testosterone levels, but
yeah.
You know. All right, folks, that is it for us today. Thank you all for being here, Chris. Thank you for your analysis. It is appreciated, especially during a time like this. I know you get a lot of shit sometimes from people, but I think many times when things are getting euphoric, you are a huge voice of reason, given the life experiences you've had, and that's valuable. It's always very valuable.
Yeah, I try to do my best to not be overly bearish just to be bearish, and I try to do it from like a point of reason and saying, look, just take a second look, and this is why you should take a second look. I don't wish anyone to lose money, right? Like I've personally like I said, I've seen people around me lose a lot of money. I don't want people to lose money, right? And
I think that's the thing that's weird about sometimes how people react to your content. You're not a perma bear. Like you've been investing for the past. I've seen you pick stocks for the past 4 years. You don't go short. So when you are skeptical, it's more so about things you're seeing. And now you might be wrong on certain parts of the skepticism, but being skeptical does not mean being bearish, like Jeremy Grantham or Burry. You know?
Yeah, and when I do get bullish on something, I invest a lot of money in getting bullish. Like, and so far it's worked out well for me, but I do need to kind of calm down on some of that too. Like I'm 90% right now in my short-term portfolio in ServiceNow right now. Like it just
is it ServiceNow options or?
Yeah, it's a lot of it is options. But it's because like I have a strong feeling, dude. Like you don't get a lot of like tinges in your back of your head, you know, just like, wait a second, like you're actively seeing this and the market is not seeing it. And one of the great things is that I have personal experience with it. So that gives me a little bit more alpha than other people, right? So other people can talk about ServiceNow. I actually use ServiceNow. So there's a big, big difference. And I know like my organization, we are not getting rid of ServiceNow. We're not getting rid of Salesforce. We're not getting rid of a lot of things. You know, so when the market says, oh, I think ServiceNow is going to be replaced by like a vibe coded piece of software where there's going to be seat compression, I'm like, no. Our growth in ServiceNow is actually growing more now because of all of these additional agentic features. So that's what I would
like them as well.
Yeah. I would just say, like I said, sorry, go ahead.
No, I'm saying it's not like NVIDIA agrees that this software company is, because I'm sure NVIDIA thinks some software companies are, but Jensen has put his stamp of approval on ServiceNow, Palantir. Like he believes these software companies will be very, very important in the age of AI.
ServiceNow actually NVIDIA actually uses ServiceNow.
Yeah.
If there's one company that could possibly replace ServiceNow if they wanted to, it would be these guys. But they're not doing it because they're like, look, there are certain things that we're good at. We need to stay in our lane. Let these guys do what they're doing and let them do. Like even among the Mag 7, they all use the same software products. If there's one threat that's out there, the Mag 7 could create their own if they really wanted to, but they understand that there is a lot more that goes into creating a piece of software, but then on top of it, getting that distribution, getting that training, getting the entire ecosystem of support people together, layering on all the integrations with other software vendors that have to come in, because you're not just buying software for one thing. You're buying it and it has to interact with other software on that organization, right? So all of those things, when you combine them together, it's not. I think the moat is a lot more durable than people think. Was I a buyer of ServiceNow at 200? No, absolutely not. I thought the valuation was elevated primarily because software, could be some compression, or at least the narrative could. But at $88, I think ServiceNow is a steal. I think there is an opportunity. I think the opportunity for this to run to 150 is high. I can't say when exactly it's going to happen, but all you need is a couple of good quarters where it kind of shows that their RPO is actually growing, and primarily from their hybrid offerings, which is their newer consumption-based agentic offerings, which, by the way, last quarter it went from like $1 billion to now $1.5 billion. And next quarter they could probably announce it and it goes even higher. And then people are going to look at it and say, wait a second, like this RPO number keeps getting higher and higher. And it's the same thing with Salesforce. Salesforce said, look, the demand for like agentic features is growing by 300%. Like if we're getting disrupted, then what the hell is this? And this is without seeing the amount of seat compression that people are kind of alluding to. So, and the last one I think that could do well too is Adobe. Adobe, you would think, is the most disruptable among all of the SaaS companies, because now people can just go to like a chat bot, an LLM, and just generate content. But then when you look a little bit deeper, you see that Adobe has a bigger moat than people think, especially among the enterprise clients. Like you need to have a lot of copyright features that Adobe has, where all of the models that Adobe provides are actually trained on Adobe stuff. You've got literally 20 years worth of people that have been using Adobe. So that's like an inbuilt moat in itself, because there's a lot of people that are like, look, I've got something that works. I'm not going to change my workflow just for a few dollars here and there. And if Adobe can successfully transition to this hybrid consumption model, they're generating enough free cash flow right now to buy back a crap ton of shares. So we'll see what happens.
All right, folks. Thank you all for joining. Kospi will be closed tonight, so we will not be doing South Korean action. So we'll be live tomorrow on the market open. We'll see how we end up. For tomorrow is a big options expiring day as well. So, that might add some volatility, but we'll see how the market turns out to end out the week. Yep. There's Chris's Twitter in the chat. Thank you, everybody. Chris, thank you as well for being on. See you guys
later,
tomorrow.
Guys. Have a good one. Bye.
Bye, everyone.